Hi. Let's learn about Go-Go funds. Go-Go fund is a slang name for a mutual fund that has an investment strategy focused on high-risk securities in an attempt to capture above-average returns. A Go-Go fund's aggressive approach usually involves holding large positions in growth stocks. Growth stocks offer higher risks, but also higher potential returns. Go-Go funds entice investors by promising large, abnormal returns created from shifting portfolio weights around speculative information. They came into prominence in the 1960s. In that decade, investors flocked to the stock market in unprecedented numbers. Investments in mutual funds more than doubled over 10 years, and by the end of the decade, 31 million Americans owned some form of stock. However, these funds often made speculative investments that did not always pan out. While Go-Go funds were quite popular during the booming market atmosphere of the 1960s, they lost much of their shine in the years that followed. After reaching a peak in December 1968, the market plummeted by about 36%. The prioritization of growth over risk created a dent in equity funds, and it would take until the 1980s for them to return to previous levels. Go-Go funds grew less popular after the stock market crashes of the 1970s, as investors grew warier of speculative investments and promises of elevated returns. The shaky stock market following the Go-Go years also contributed to a growing interest in investment diversification. Here are 3 key takeaways. 1. A Go-Go fund is a mutual fund with an investment strategy focused on growth stocks and other high-risk securities. 2. These funds were at their popularity peak in the 1960s, appealing to investors drawn in by the promise of unusually high market returns. 3. However, the funds were often fueled by speculative investments that were unreliable and lost their popularity following the stock market crashes of the 1970s. Hope this would help. Thanks for watching.